Hey everyone, it's Larry Kotlikoff with Economics Matters, the podcast. I'm delighted to have Kevin Esler, who's provided free of charge to everybody in the country uh, a great website for building TIPS ladders. So a TIP is a Treasury inflation protected security. So we can buy bonds either directly from the government or in the secondary market, bonds that have already been issued and purchased by somebody else. We can buy the bonds from that somebody else on the secondary market through our broker. It could be Fidelity Investments, it could be Vanguard, T. Rowe Price, Merrill Lynch, lots and lots of brokers out there. And like buying individual stocks, we can buy individual bonds. These bonds that are called TIPS and Treasury Inflation Protected Securities, they were first issued in about 25 or so years ago by a classmate of mine, Larry Summers, who became Treasury Secretary. And when he got into the job, he said, hey, well, here's a missing security, which is one that it's a government bond. So government borrows money, promises to pay you back a stream of payments called coupon payments, and then a principal payment at the end. Maybe it's a 20-year bond, 20 years of coupon payments, a principal payment at the end. But unlike other bonds, these coupon payments are indexed because they're paying an interest rate times the principal, and that determines the coupon, but the principal is being adjusted every year. So the interest rate times a higher coupon, sorry, a higher principal, it's adjusted for inflation. That spells a bigger coupon. So that means that the coupon payments themselves, as well as the principal that you get at the very end, are going up with inflation. And as they go up every year, you're protected against inflation because you get a coupon that's uh, whose purchasing power stays even with inflation. But on the other hand, the increase in the coupon that's reflecting the adjustment due to inflation of the principal, it's that fixed interest rate times the principal, that higher coupon that's uh, risen risen just due to inflation. That's called phantom income because it's additional coupon income due to inflation. That's subject to taxation. So that's one of the downsides of really any bond, that the inflation element of a bond, the return that's reflecting prevailing inflation, is subject to federal income taxation and state income taxation. We have 42 states that tax income. So anyway, apart from that, TIPS are great deals, and they're particularly great deals today, not just because of the inflation protection and the fact that we've been running inflation, we're worried about future inflation, but also because um, uh, these uh, uh, these TIPS can help us insulate our future uh, income needs from inflation. And they're also a great deal because their yield, their real yield, the the interest that you're going to get above and beyond just being compensated for inflation is quite high. It's about 2%. The term structure, no matter whether you buy short-term TIPS or 30-year TIPS, that's the highest, longest maturity you can buy. It's really running around 2 or 2.12, 2.2%. That's pretty much the highest yield we've seen for a quarter of a century. So we have here Kevin Esler. Kevin is a retiree, lives in Bedford, Mass, and he comes to us by way of Australia, a long distance. And he is retired at the moment, although it doesn't seem like he's all that retired from what he's doing to help everybody. And before retiring, he's going to fill in his full bio, starting from when he was a 3-pounder in Australia. Uh, he's going to tell us his entire career rather than my droning on. But Kevin worked for Disney Plus, and Disney Plus is the streaming arm of Disney. They produce the Disney movies, not just the cartoons, but all the Disney uh, uh, videos that we can see on the different outlets. So Kevin's been doing that for the prior 3 years. Now he's retired. But Kevin, welcome to Economic Explaining Economics Matters, the podcast. Tell us, say hi and tell us about your early days in Australia, what brought you to the US, your education in Australia, your whole job career, and then why you built this really cool tool called tipsladder.com that we're going to go through in this podcast and show everybody how to actually build a tips ladder. I know that we've had other podcasts with Jay Apolofia has done one, an excellent one that with our Maxify planner users in his office hours. He's going through this, but we're going to do it some more with the actual inventor of the tipsladder.com. Go ahead, Kevin.
Thanks for having me on, Larry. I'm a fan of your podcast. I've attended some of these in the past, and I've made good use of your products too. So we appreciate the work your company has done. Let's see. Yeah, I was born in Australia quite a lot. Well, I was born in 1955. Let's not beat around the bush.
Okay, you're younger than me by 4 years. You look a lot younger. What part of Australia were you born in?
A small town, probably at the time it was about 30,000 people in a rural area between Sydney and Melbourne called Albury. Most of my uncles were farmers. My father was a surveyor. I spent a lot of time on farms as a kid. I was pretty good at mathematics at school, so I turned 18. I went to Sydney University. Initially, I was enrolled in civil engineering because my father had a surveying company, so he was keen to get a partner. But I discovered computers while I was there. Yeah, it was very early days back then. Initial programming experience was on a mainframe. I think Fortran was the first language, but yeah. So
Are you typing cards like I was for my dissertation?
I used punch cards very early on. I think in second year we got to use teletype paper printing terminals, but
Which were massive, right? They were like 3 feet across, right?
These were smaller ones, but they were logged into the mainframe, and then so I ended up getting a double degree in pure mathematics and computer science, and I went out and tried to find a job. And I worked in Australia for a number of years. So this was back in the 70s and 80s, late 70s, early 80s. We didn't have an internet, of course, and opportunities were a little bit limited in Australia. So at the time, I was working for Honeywell Information Systems for a while. They were in the mini computer game back when mini computers existed. And I was doing some good work for them, debugging their operating system. They had a pretty big installation at one of the universities in Sydney. So I was sort of like the on-site support guy. I was fixing up a lot of bugs in their OS. The people over here, I think based in Billerica at the time, said, we like what you do. Would you like to come and work over here for a while? So I think it was 1984. I finally came over. Didn't think I would stay too long, but one thing led to another. And so I've spent my entire career doing software. I found I enjoyed the technology. I was pretty good at it. I think having the math degree was a help. So I worked for Honeywell for a while, then I got a green card, did a master's degree at BU.
My employer.
Right, yeah. Started a PhD, but it was a bit late in life for me, so I didn't finish. I did some of the coursework, but no, I'm glad I didn't. And so then I had a bunch of jobs. I was a generalist. I didn't specialize in any particular application domain. I worked in some online banking, a bunch of other stuff. Worked for HP, worked for big and small companies, always in the Boston area. What else? Yes, I kept up with the technology to the extent I could. Kind of important if you're in software because it moves pretty quickly.
So Kevin, tell me, one of the interesting things you're saying here is that you're switching jobs a lot during your career. Why is that?
Well, I wouldn't say I was a big job switcher because I did spend 15 years in one desk in Lexington.
Okay.
Started out as a startup and then it was acquired, merged, acquired, merged, acquired. We ended up part of IBM. So I did sit in one place for 15 years. That was a mistake because, yeah, I think in the software game, you do need to move around a bit more frequently than that just to learn learn new things. You can get very stale if you stick in one place, especially in a big company like IBM. So
Because a big company says, hey, we really need somebody to do this and do it right. And this person is doing it right. And we're going to keep him forever or her forever
yeah,
because that's satisfying our need. And so that's a good rule or lesson for everybody whose career in the working world right now, that you may not be able to progress inside your company. You may need to or even threaten to leave in order to get them to move you, so that you get this on-the-job training. I mean, a good part of there's a guy named Michael Spence who got the Nobel Prize for his work on the economics of education. He wrote down a framework or model that says that education has no value per se. That the only thing education has is a value to kind of test people, separate the weak from the strong from the weak. I guess the chaff from whatever it is, whatever that expression is, the grain from the chaff, and it's just uh, a way for companies to see, hey, this person graduated from this school with good grades, so let's hire him because then we can train him on the job. So that tells us that uh, that view is that all the training is on the job. And once you've learned something, there's nothing more to be learned. But to uh, to be able to direct other people, you need to know lots of different tasks. So accumulating those tasks through time by switching jobs is a lesson we're just learning right here from, or relearning from Kevin in his career. But anyway, what brought you to work on this tips ladder, tipsladder.com website? And we're going to show that to everybody in a moment, and I'll show you what I know having played with it, and you'll tell everybody some of the things that I don't fully understand, and we'll have a good time talking about it.
yeah. Well, let's see. Um, so I ended up, thanks to my assiduous use of Maxify and before that ES Planner, I was able to retire at the age of, I think it was 65, yeah. And but at the time, I had a bunch of my retirement funds in a stable value fund that I'd inherited from my IBM days, and I was a little bit concerned about inflation. Stable fund is great because it's stable. It's like if you look at the graph of the value of the fund, it goes straight line. I think it was at 2.5 or 3%. Anyway, I was concerned about inflation, and years before, 20 years ago, I joined the bogleheads.org online investment community. And so my investment approach had been guided by them. And so I'd read quite a bit about tips, and I was concerned about inflation. So I thought, all right, maybe I should move my money. It was a considerable chunk of change, about, I don't know, 40% of I think I was a 60-40 stock bond guy when I retired. So I had about 40% in this stable value fund. And I thought, oh, well, how can I do better? So did some research on the Bogleheads site, and they're recommending a tips ladder. And then I said, well, how do you build a tips ladder? And the only thing available at the time was a spreadsheet. I mean, it's a brilliant spreadsheet written by one of the Bogleheads, a guy called Cruncher. And I tried to use it, and I found it I wasn't smart enough to use it, I think. So I thought there's got to be a better way. So I sat down and started to write some code. I mostly wrote the code so I would understand tips better, because I wanted to understand what I was investing in. Anyway, I ended up having something that more or less solved the problem for myself. And then I thought, well, the Bogleheads have been good to me. I think I'll just turn this into a web service that they can use to build, to more simply build tips ladders. So that's how it arose. And I think I did some of this work under partial quarantine in the COVID era.
Uh,
I got a
So,
bit of free time then.
so by the way, for everybody, Bogle has refers to a group of people that have great admiration for John Bogle, who started uh, Vanguard, and Bogle, I think, has now passed away, if I have that right. But John Bogle was a big proponent of investing in index funds. Basically, that connects with what economics says for years now, for decades. You know, when people started working in the 50s, Markowitz, Sharp, Merton, all the great people in finance who got Nobel Prizes, the basic message was you don't need to hold, you're not going to beat the market unless you have some inside information that nobody else knows, and you're trading on it, and that's illegal to begin with. And by the way, diversification is pretty, uh, pretty easy in the sense that you could just take a dartboard, put up the names of all the stocks on a big dartboard, a huge one. There's 6,000, maybe 10,000 stocks and bonds, and internationally, maybe there's another 10,000. Just throw 17, 20 darts, grab those, and invest equally in those, and you're going to have lots of diversification. So there's lots of economies of scale and diversification. But the issue is getting diversification at low price. And what Bogle came up with was this idea of index funds, which is hold everything in proportion to their share of the market. And that's coming right out of the economics of finance. That's coming right out of the early work of Markowitz and Sharp and Tobin about diversification, the economic gains from diversification. But why not hold? And it's basically says hold the market and hold the market. And the market is, you know, so much GM in proportion to, you know, if GM's 2% of the global of the stock market, you hold 2% of your shares of stock should be invested in GM. In other words, if you have $100,000, then $2,000 should be invested in GM shares. And then if bonds are, you know, 60% in total of the value of the stock market, then 60% of your assets should be in these risky bonds and 40% in stock. And that's basically, you know, holding a diversified portfolio of both bonds and stocks. That's holding the market, and then if there's global securities, so it just extrapolates from there. So there are index funds now for bonds, or index funds for stocks. There's index funds for international funds, for developing country funds. So there are something like 10,000 mutual fund companies, and there's probably in terms of mutual fund combinations of these different securities, there are many, many more. But then if you just want to hold you know, the entire stock market, the entire bond market, the entire international market, you can go to Vanguard, for example, and just get those three funds and be all set, and do so at extremely low cost. Right now, the Vanguard VTSAX fund, which holds the entire US stock market, you have to pay 3 basis points. If you have a financial advisor, they're likely to charge you 1% of the value of your assets. So if you have, let's say, 10 million bucks, that's $100,000 a year for something that can cost you $3,000 a year. They might be investing you in ways that are not as diversified, and actually putting you at risk, because their 20 picks of stocks or 40 picks of stocks they're not random. They're based on their insight, which can be all screwed up. So anyway, that's a little bit. And the Bogleheads was a group of kind of common followers of Bogle, who got together on like kind of a chat line and have been talking to each other. And I occasionally uh, uh, get involved in there. If you just Google them, they'll have some kind of I forget whether it's on LinkedIn or whatever, uh, a thread on one issue or another every day. So let us now go to really illustrating tipsladders.com. And what I'm going to do is share my screen with that background. I'm always a professor, so I always tend to spend a little bit more time talking about things than maybe I should. Uh, my son Alex thinks I drone on a bit, and I think he's right, but I can't get this professor aspect out of me. So I always try and teach people about everything I know about everything. So it takes, so I apologize in advance. What you're seeing here is just a prelude to going to the tipsladder.com. This is Maxifi Planner. For those, a lot of people are familiar with it. We have this company, Maxifi.com, and we have, a software that's economics-based financial planning. Here's a case of a household, Morgan and Jen, and Morgan's making, he's like 55, he's making 125,000. These are a high earning couple that she's making 200,000. That's not the typical household. These are people that are quite well off, except they have saved very little in the way of assets. Really, they've got 1,500,000 retirement accounts, and they're in their 50s and 50,000 in assets. They've got two kids who are in high school. The baseline assumption is that they can earn basically 2%, which is the yield on tips right now. So they're trying to play it safe. This is deterministic planning. And if I run their report, I can generate, given that they want to retire at 62 and take Social Security at 62, and I've demoed this particular couple before and shown how to rescue their retirement, which has them working at their lifetime discretionary spending is 2.7 million. Their fixed spending on taxes and housing is 4.6. So they're spending a lot on fixed stuff, and their lifetime resources 7.4. So out of the 7.4, they're only getting to spend 2.8 of the 7.4. And the software is getting them to having them smooth their living standard per person. You can see that when the kids leave the household, the discretionary spending, which is all in today's dollars, is dropping. And then I've assumed that they're going to gradually have their living standard drop per person. And you can see that the living standard is nice and flat, except when they want to have it decline as they realize they can't go on travel as much because they're older and don't need to buy fancy workplace lunches and fancy clothes. So that's Maxify for those who are not familiar. And I set up a profile where I can basically have them work till 65, take Social Security at 70, move to Tennessee, buy a $500,000 house, sell their $1.5 million house with a $500,000 mortgage, and then do a small Roth conversion. And if I run that case, when I want to duplicate this, I just want to show you real quickly that we can compare that with their base profile and do some economics magic here. So they have to work 3 more years each. But now I've raised their living standard. Their lifetime spending, discretionary spending, is now going from 2.7 up to 4.6, which is almost a doubling in their lifetime discretionary spending just by, and with no uncertainty here. They just work longer, take Social Security later, move to Tennessee, do a Roth conversion. Bingo, they're dramatically better off. So you don't need to spend $100,000 or 50,000 or even 20,000 on a traditional financial advisor who's not using the software to get to a higher level of living standard. But let's go back to their base profile and go back to that case, the base plan, which I've already run. And I want to show you a couple things. One is that their plan, if we look at this saving here, they have, first of all, in their retirement accounts, they have a plan for withdrawing their retirement accounts starting, uh, they've told the program they want to start withdrawals. And they don't have any Roth accounts in this case, and we're not dealing right here with Roth conversions, but they want to take out first 49,000. They both want to start withdrawing when they're 65. So one of them 65 before the other. So for a while, we've got Morgan withdrawing at 49K a year in today's dollars, and then the two together are withdrawing 79,000. So this is what they need to target for over this period. They'd like to have this, years of smooth outflows from their retirement accounts, and the tipsladder.com is going to help us get there. And then over here on their regular assets, they also have a plan for needing to withdraw money from their regular assets, and they like to basically insulate that if they would, well, I'm assuming that they would like to make that for sure, since the program is assuming basically they're investing in tips. Well, how can they actually get out 11,710,000 in today's dollars when they're age 72 and age 69 in 2040. So how do we do that? Well, let's go to tipsladders.com, which is right here. And I'm going to just give you an example of if you were, so let's forget that example of and Morgan and Jen there, and just talk about your yourself, and you want to get a stream of income. Maybe you want to have that start in 2030, starting in 6 years from now, and continue for till maybe 2050. And you want to have perhaps $50,000 coming out per year. So you might be, let's say, 70, and you'd like to have a constant stream of $50,000 in today's dollars coming to you in the form of principal payments from tips that you would buy. And now I'm going to leave these things as they're at the default value. And Kevin's going to tell us about those in a second, but I'm just going to create the ladder, and then Kevin is going to talk us through what we're seeing. So Kevin, take it away.
Okay, so what it produces here is a shopping list of bonds to buy. So the second column there is your shopping list. The first column indicates what year is being funded by that particular holding. Yeah, so you've got to buy, 31 of those and 22 of those, and so on down the list.
And these are called QSIPs, right? These are the, if you went on to like a Vanguard's website or Fidelity's or any other website of your broker, you could actually potentially just buy these yourself. I've been buying these myself just by entering that QSIP. I say, I want to buy, I want to trade. First thing I do is I click on trade in my Fidelity site, and then it says, well, what do you want to trade? I say fixed income, and then it takes me to another screen, and then it says, enter the QSIP. What bond do you want to buy? And I enter this, let's say this number. I just copy it, paste it in there, and bingo, it comes back with, well, tell me how many of these you want to buy. In this case, you'd be buying 42, right?
That's it, yeah.
Okay.
Yeah,
now,
so
the
rest of the table just says for each year how much comes as interest from later maturing bonds and how much is from principal for bonds maturing in that year. So in this case, we end up with you notice that it's not the same amount every year because tips, you have to buy whole tips, so they're not, you don't get the exact 50K per year, but in this case we get an average of 50K in the right hand column.
Okay, so tell me about so this is giving us about 50K. So tell me about this number. So here's the principal. I bought 42 of these particular tips, and now I'm getting about $42,000, $42.8 thousand back. And then this is interest I'm going to be receiving in that year from the other coupons, from the which are coupon payments from the other tips that are coming due later in the future, right?
That's right. You also get a final coupon when the tip matures. So you get a little bit of interest from the tip that's maturing, and then but most of it is coming from bonds that will mature later in your ladder. So
And then tell us about this number, which is quite interesting. Uh,
okay,
that's
so in this case, we said we want a stream of income starting in 2030. Well, today it's 2024. So if you buy the tips today or tomorrow, probably, those bonds will produce interest each bond produces interest twice a year. So between now and the first year that you wanted to fund, you're still receiving interest from all the bonds you bought, and quite a bit of interest in this case. So yeah, so before 2030, from all that big bundle of bonds you bought, you're gonna get a total of $67,098.
and that's assuming that you could reinvest that for up through 2030, all those coupons just at a zero return, real return, that the return went down to zero, and that so you just got those coupons and you're just adding them up, and they're staying even in today's dollars. Now, notice, of course, that based on, these results here are predicated on what the market assumes the inflation rate will be into the future. If the inflation rate is higher, all these numbers, which are in today's dollars, stay the same, but your taxes would be higher. But if you ran that in Maxify with a higher inflation rate assumption as well as a higher nominal rate of return, so that the difference between the two, the real rate of return, was what it is today, around 2% or 2.2%, you would Maxify would pick up the higher taxation, this taxation of phantom income, and it would still say, well, look, I want to get 50K out from my retirement account every year starting in 2030 for this period of time for 20 years, and but I also have those withdrawals from my regular assets, and they're going to, that whole plan is going to be reflective of the fact that you've used a higher inflation rate as an assumption, and therefore going to be paying higher taxes on these tips. But so now we've run this case, and I just want to point out that, if the assumption is that this is being spent between now and 2030, kind of the implicit assumption here, and that the other money is coming out, and you can see you really get to about 50,000. It's really cool, and it's that quick. You just click on the thing and bingo, you're getting this number back, and you're spending this before. Or you could take that money and buy more chips that would come due in future years. Or you could even possibly reduce the amount of some of these purchases and just assume that you'll reinvest this money, let's say very conservatively, at a zero return, and therefore maybe you don't need to buy that many tips for 2041. You could just, for example, buy maybe 20 tips and use, well, that's even more than 50,000. So you could just allocate that over a couple of, or maybe even over all these years, so that you don't need to buy so many tips and then would have 50, be able to use the pre-ladder interest to cover the stream. But let me go back to tipsladder.com, which is one of my favorite websites now. And let me suppose that I wanted to buy I wanted to buy a certain amount of tips, maybe $10,000 worth of, I need 10,000, maybe Maxify says that out of my regular assets, I need to take out withdrawal $12,341 from my regular assets. And I'd like to use some of my regular assets that I have right now and buy tips so that I can get $12,341 in real dollars coming out uh, from my regular assets, not from my retirement accounts. So I want to have in effect, a 1-year ladder that produces that amount of money, and I'm going to create the ladder. And here's how I could do it. I could buy 12 of these particular tips that come due in 2034, which is 10 years from now, on the secondary market. And you can see that they're currently yielding about a 2% real return here. That's an internal rate of return. And but that's going to, the pre-ladder interest is around 2,000. I really only needed about whatever, $12,341. This is very close. So I could just eat that money as it comes in, or I could reduce this to maybe like 10 tips, and then the principal would be lower, but and the pre-ladder interest would be lower, but the two together would be potentially around $12,341. So that's another way I can think about hitting exactly $12,341 by using the pre-ladder interest as well as the principal to hit that target. So you can target for a stream of payments, or you can target for just 1 year's. You can make a smooth tips ladder or a non-smooth tips ladder. You could have figure out, hey, I need this much money for this year coming out of regular assets, this much money for next year coming out of regular assets, withdrawals, and so forth, and make a tips ladder for 1 year, year by year. And that's what I've been doing for my own planning. But let me ask now, Kevin, if you could, if I've said anything wrong, please correct me. But I want to ask you about some of these inputs here. We have these 4 different options here. We have 4 different options here. We have average, minimum, specified for each year. So tell us about these options.
Okay, well, the best way to explain that is let's go and press the create the ladder button, and I'll show you something on the table that's pertinent here. Let's make a longer one that goes up to 2044 or something.
Okay.
Yeah, just go up there. So anywhere there is good. Yeah, create the ladder. And now you'll see that for the years 2036 through 39, there are little the superscripts.
Right.
The current problem, or the current complication with tips, is that there are the government hasn't issued any tips that mature in the years 2035 through 39. This problem will go away over the next 4 years because they will very likely create 10-year tips beginning in 2025 through 2029. So those what I call gap years will disappear. But so the problem arises, well, what do you do about the years when no tips mature? How should you approach that? And so if we just hit the back key, we'll go back to where we were. And so that's what the 2 parameters here are for. So the first one is which tips to use to fund a year that doesn't have a maturing bond. And there are 4 choices. The first 2 of the choices will select the bond to buy to fund that year. The 2 reasonable options are pick a bond that's maturing in the first 2 choices pick a year, and the second option picks the bond. So let me start. Let me try that again. So yes, so there's 2 ways to fill the gap. One is to just pick another year and then pick a bond that matures in that year. And it's a subtle difference, but the other choice is pick a bond that matures close to the year you want the money. So the second 2 choices pick a bond. So the choice number 3 you have highlighted there says just pick the bond that matures nearest to the start of the rung year that has no maturing tips.
right.
And
And
the
run
second,
year refers to the kind of the year you're focused on.
the year to be funded, let's say.
Yeah,
And then the fourth choice, if you highlight the last one there, it's that says to fund a gap year. Pick the last one to mature before the start of the year. I want the money. So many years will have several bonds that mature. Typically, it's January and August. I think, yeah, January, February, maybe February. I forget now. April. Yeah. Anyway, and some years have tips that will mature in February and August and April. So pick the one that's the latest to mature in the previous year. That's what option 4 is. Now,
okay.
so
So they're all before, basically before these gap years, but they're different ways of being before. Either
actually not necessarily before, because option 3 there says pick a bond that's maturing nearest to the start of the wrong year. So if you're in, you may pick a bond that matures later, if that's the nearest one in time.
got it. Okay.
And then the first two options say, all right, first pick the year and then use the second pull down to decide which bond to choose in the year. So as I just mentioned, some years there are several tips that will mature. And if you go to the second pull down there, this answers the question, well, which bond to buy when there's more than one to pick to fund the year. So you can normally you want the best yield, I imagine. So that's the first one listed. Some people may want the earliest to mature within the year. Some person might want the latest to mature in the year. And some people want the one that has the lowest inflation adjusted principal. Reasons which we need not go into, but it's got to do with minimizing the risk of deflation. So those 4 options guide the tool as to which bond to pick within a year.
Mhm. And the tips are mechanically, I know that they pay coupons twice a year, right?
Yeah.
Are they all issued on certain dates, the new tips?
Yeah, they tend to be. I have a list of them here somewhere. Yeah, I think it's
Like January and June or something like that?
January and July or August. I forget now. Some of them are in April. It's a little bit. It's not completely consistent. I don't think.
So you could be buying a tip for like 2050 and it won't, it might come due, that tip that you're buying could come due in March, whereas there might be another tip that comes due in 2050, but it's in October. So
Yeah.
this is giving you whether you want to buy the one that's coming due in March versus October. That's what these options are about. Now tell us about this guy down here, this average versus minimum
Okay.
versus.
So we just built a ladder that says I want income of 10,000 a year on average. So if you create the ladder, Larry, press the create ladder button, you'll see that some years there's less than 10,000 in the right-hand column.
Right.
So if we go back, you might want to be sure you get 10,000 at least. So the second option there is you're specifying a minimum. Instead of an average, you say, give me a minimum. I definitely want 10K, no less. If you create the ladder there, you'll see that all the numbers in the right-hand column are at least 10K.
Got it. Right here. Right.
And then the third option, if we go back, let's make a smaller ladder, say just a 5-year ladder. Oh, there you go. So we made a big one. The third option is, okay, I want potentially a different amount of income for each of the years in my income stream, and it seeds it with just whatever value you recently typed in. But now you can change all these. So you might want some years with no income, and some years with 30,000, and some years with 20. So if you go
let's try and do this again. So you want me to do last year to be funded to be 2028, for example,
Yeah, you make a small one, it's easier to see, yeah. So if it,
3 years.
yes, now specified for each year. And now you can change, say in 2026, you don't need any. You could set that to 0.
Okay.
And maybe 2026. Let's keep 2025 at 10K. And maybe 2026, you don't need any. You'll still get some because of interest. And maybe 2027, you want 40,000.
Right. And this could, by the way, mimic exactly your withdrawals from your
Yeah.
regular assets. Yeah.
Right. So now if we create that ladder, you'll see what we get. We get a shopping list again. And fairly short one. And you see that in 2025, you get your 10K. In 2027, you got your at least 40K that you wanted, getting a little extra just because of the granularity of tips, and then 10K in the final year. So 2026, you didn't want any income, but it's giving you 1,382 anyway, because of you can't avoid getting the coupon payments for the later maturing bonds. So.
And by the way, for everybody to know, you could have 2 tips that are basically coming due in 2050. I mean, imagine you bought, or let's say 2054, which is 30 years from now. You could buy today, you could buy a 30-year tip and it would be coming due at some point in 2054. But 10 years from now, you could buy a 20-year tip, which would be coming due in 2054. And let's say we're sitting here 10 years from now and we're running this and we have the option to buy the tip that's going to come due, let's say early in 2054, and the other one's going to come due later in one that was issued this year and the other was issued 10 years from now. And we're sitting here 10 years from now. Well, these 2 tips are going to be producing a different amount of pre-interest, pre-ladder interest versus principal. So one of the tips might have very little pre-ladder interest relative to principal. The other could have a lot of pre-ladder interest relative to principal. And then if you have a lot of pre-ladder interest relative to principal and you don't want to spend it in the year that pre-ladder interest comes, the pre-2050 interest comes, then you're going to have to reinvest, and there's reinvestment risk. So if you're buying a tip that doesn't have a lot of pre-ladder interest, you're reducing your reinvestment risk. So that's one thing to keep in mind, that you might want to kind of be looking at these different tips that are available and asking yourself which one has less. I really just want to get money for 2050. I know if I buy this tip, I'm going to have to reinvest the pre-ladder interest. And I don't know what interest rate I'm going to be investing it at, what real yield. So I'd like to buy a tip where I know the real yield, the real internal rate of return. It's kind of indicated for this one, it's 2.3%. But I'd like to get that for sure for all the money I put in today, and not worry that the pre-ladder interest, I'm going to have to reinvest it at 0 or maybe 1%, or it could even be negative. We have seen tips in the late 2019 or so, 2018, we saw those tips returns being negative for some maturity. So am I saying the right thing here on that, Kevin?
No, that sounds about right. Yeah.
Cool. Well, I think we've done a great job really talking through this terrific tool. Kevin and I are going to sit down with our company's chief engineer, Ed O'Connor-Giles, who's a genius who never got any computer education per se. He just went off and studied English and then went off and started working, got interested in becoming a software engineer, and started working for a company, and ended up running Wisconsin, a good chunk of Wisconsin, University of Wisconsin's computer system. And fortunately, we were able to hire him I guess it's been about a decade ago. And then he moved from Wisconsin to Providence. His wife has a job in the biology department as a professor at Brown. And maybe he was part of the reason I moved to Providence from Boston, because I have to commute. So he's imposing a major tax on me, but you're gonna like meeting Ed. And we're both excited about the prospect of integrating tipsladder.com with Maxify Planner so that people can run Maxify Planner or then click another button and then see how to build a tips ladder. And it's not just for the base plan or your alternative profile we're running deterministically based on an assumed tips return or assumed safe return, because we're not telling you to buy tips or not. We're just illustrating if you did and if everything turned out in terms of what the inflation assumption is that you're making and the taxes you're going to have to pay, what things would look like, trying to educate you. But then we also have this upside investing where you're assumed to be investing partly in the stock market, but not spending anything out of the stock market until you take your stocks maybe years later and gradually or quickly convert those into tips. But the rest of your money, we're assuming you're investing in tips, and we're building a living standard floor and then just giving you upside to your living standard because you're always spending out of safe assets. So if you don't spend out of your risky stocks until they've been converted into safe tips, then you only have upside risk. And there's still risk associated with future inflation that you don't know about. Whenever you never know what the inflation rate will be in the future. So you could certainly take a conservative approach and put in a high inflation rate just to protect yourself with a high nominal rate of return. Anyway, so at some point, hopefully in the near term, we're going to be adding a feature to Maxify Planner, which basically will use Kevin's software as an API, his code, and say, okay, you want to build a tips ladder and produce this stream of here's a little module you can run to do that. And so I'm excited about working with you on this. That'll be great for, I think the guys and the gals from Boglehead will be super excited because they seem to like our software quite a bit. And the combination of the two programs will be really fun for them, and I think for everybody. So Kevin, can't thank you enough, and I'll bring this now to a close, but we'll be getting together soon. Thanks again.
Thanks for having me, Larry. All the best.
Thank you. All the best to you.